Hello, everyone, and welcome to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. So, on today's podcast, I'm happy to welcome Mark Humphrey-Jenner, who's an associate professor of finance at the University of New South Wales. So, Mark, thanks for joining the podcast today.
No, thanks for having me. It's nice being with you.
Yep, definitely. Same with you. So many people, I guess, have thought that the recent inflation that we've seen over the past few years would be transitory, especially many of the central banks and some of the, I guess, big investors out there. So if we look at it from your perspective, why do you think they've gotten this so wrong?
Yeah, there's probably a few reasons. One, I think, was probably like wishful thinking, right? Like you look at the inflation, you think, well, hopefully that will settle back down. And then sometimes you'll see like the market a little bit reverse inflation wise. So, like during 2021, we'd see inflation pick back up, and then there'd be a month where it dipped back down. And the people would sort of think, well, maybe inflation is falling. So people perhaps lulled into a false sense of security. I also think people at the time thought the economy was doing much worse than it was, so maybe underestimated the impact of fiscal stimulus. So, in particular, if we're looking at the US, there was a ton of fiscal stimulus in 2021, so 6 trillion worth or thereabouts. And it seems like some people at the time thought that was super necessary and wasn't going to be inflationary. So perhaps underestimated the impact of that. And the central banks seemed to in the US, and more generally, that was the case. But the US demand driven inflation then filtered through into everyone else. That said, a number of people were warning at the time. So, for example, Michael Burry was warning at the time. Mohammed Al-Arian was warning at the time. Quite a lot of people were warning at the time that it was going to be more persistent. So, yeah, they probably got it wrong for that reason. I also think they drastically underestimated the velocity of money and the fact that when the stimulus was going into the economy, the velocity of money was super low, and then that picked back up as the economy started to really recover and lockdowns ended. So they were looking at the idea that if you have got stimulus and the velocity of money is quite low, then it won't be too inflationary. But velocity was depressed due to people being under lockdown. Then when that unwound, we got inflation. So that seemed to be what was going on.
Yeah, so you think they could be, it's almost like a recency bias as well. Because if you look back at the last 15 years, they've been throwing the kitchen sink and hoping to get inflation. So now that they had it, they're like, oh, we don't want to, destroy it while we've got it. So I guess you could say that was the thing as well. They didn't want to act too quickly as they had in the past and destroy growth.
Absolutely. We're seeing that in Japan at the moment, right? So, like, Japan has finally gotten 2% inflation. So, the central bank is desperate to try to keep that inflation. And they might ultimately end up acting a little bit too late if they're really trying to stimulate inflation too long. The ECB seemed to just pump fiscal stimulus or monetary stimulus, sorry, into the market since 2011. So, everyone seems to think we can just do QE forever and everything will be automatically fine without necessarily thinking about some of the problems that can arise in particular market conditions.
Yeah, well, if you look at Japan, they're really in a catch-22, aren't they? Because they want to keep yield control, but then they also want to protect the yen. So I'm not sure how they do both of those things at the same time. I think people are saying they're going to sell many of their foreign currencies that they own, and they do have a lot. They have over $1 trillion worth, but there's only so long you can do that.
There's also only so long you can do it and actually get people in the country being happy with it. Because if they're basically devaluing the yen, right, then the cost of making things goes way up. The cost of buying anything from overseas goes up. And while it's nice to be able to export things because your currency is weak, it's not so nice if you need to make things and import in iron ore or import in steel or import in oil and gas. So they are going to run into problems eventually with the currency devaluing.
Yeah, definitely. And I think the main issue for them is just how much energy they need to import, especially now they're closing their nuclear power plants. So that's really going to be, and food, I guess, and all that stuff. That's where they're going to see the pinch, I think.
True. They might run into the same problem Germany seems to be having with the lack of nuclear and the lack of real renewables taking hold to enough extent and then end up reliant on, in that case, Russia. So hopefully Japan will sort of have a bit of a workaround and won't run into that many energy problems, but we'll see.
So if we look at maybe a year ago, do you think in hindsight that all these central banks, not go as quickly because they've basically tightened quicker than they ever have before? Do you think they should have maybe just gone a little bit slower? So, 25 basis points here and then slow down, see how the economy reacts and go from there? Or what do you think they could have done to maybe prevent it?
Yeah, hindsight, I guess, is
Yeah.
2020, right? So we can all kind of sit back and say, well, they should have done X. But at the time, it's not like super easy to know, well, we definitely should hike rates now. Because if you've got rolling lockdown, so in 2021, we had Omicron coming along, and then it looked like things would get much worse. So it's all very easy for us to say now they should have hiked, but maybe at the time it didn't look like it. I think the central banks have some issues they need to deal with, primarily because they basically have two things that are in their mandate. You've got employment and you've got inflation. So the central bank, when it's facing significant fiscal stimulus coming from the government, it runs into major problems. Now, I think the situation in the US is very different from the situation in the UK and Australia and Europe. In the US, there was a significant amount of fiscal stimulus that wasn't just there to mitigate lockdowns. So you compare it to the UK or Australia, where there was a lot of fiscal stimulus, so a lot of government support for businesses or individuals, but they also had draconian lockdowns. And they needed to find a way to remedy the impact of that, hence the stimulus. But in the US, you didn't have that, so it was basically just free money going to people. There were eviction moratoriums and there were repayment moratoriums, and there was a lot of money coming in, so $6 trillion or thereabouts. So you ended up with a lot of demand driven inflation, which is a little bit different from what was happening in the rest of the world. However, what's happened in the US then filtered through elsewhere, particularly when you have the supply shocks. That said, in 2021, it would have been better if the central banks had moved at least a little bit to signal that they knew what was going on and that they were on top of it. Because as soon as people get expectations, inflation will keep going on and keep going on and keep going on. You'll get wage hikes, and you'll also ultimately end up with people expecting more inflation, so they'll go and buy more, which triggers more inflation, etc., etc. So they should have at least done some signaling back then, particularly as the economy was recovering.
Yeah, and I think they kept saying like it's a K recovery. So I guess many of the people who are working from home but their lives haven't really changed. They've still got the same demand. They're doing well. Many of the people maybe in services industries aren't doing as well. But the challenge with what they've done is, sure, maybe the people lower demographics working those services jobs weren't working, but the other people were doing fine, and now they've just really increased demand, I guess you could say.
Yeah, it's a bugbear I have with a lot of the commentary I see around at the moment, particularly as it relates to the consumer, in inverted commas, where people keep talking about the consumer is strong and the consumer is spending, but then completely ignore that the consumer's a big spectrum of people, some of whom have money, some of whom don't, and that will also be across the wealth spectrum as well. So there are some people, for example, landlords, who are smashed during 2020 and 2021, who are really a little bit cash poor at the moment, even though they're asset rich. And they would probably be in the higher income decile, but they ultimately end up getting hurt. Similarly, in the lower income threshold. And we're seeing at the moment people just say consumers are spending and they have a lot of money in their bank accounts, but they're basically just looking at averages, which is really completely pointless because it only takes a couple of deciles being hit for you to start getting into recession territory. So we're still seeing that mistake being made at the moment, I think.
Yeah, and if you think about the people who, like as you said, the top 1% will have the majority of the savings and the earnings, and probably the majority of the spending power as well.
Yeah, I think it again depends a lot on the country as well. I can speak from, say, Australian experience. You've got a slightly interesting situation where, like I said, you can get a lot of asset rich people. So people who own property, right? But rents nosedived in 2020 and 2021. There were eviction moratoriums, less travel from overseas, and this triggered much lower rents and significant reductions therein. So you're seeing a number of people who, on paper, would have quite a lot of assets, but ultimately have had cash flow problems. And I think that to some extent gets a little bit buried in the data. And the reason I think it gets buried in the data is it looks like those people have gotten a reduction in their net debt, right? Because they're paying off debt over time. But paying down principal in some of those properties doesn't necessarily mean they've got more cash to spend. It just means they've got more principal. So I think there's some nuance in the data that sometimes just gets lost when we look at net debt or net cash holdings that people have, that I think perhaps needs to be disentangled for us to really know what the impact is going to be of rising interest rates, for example.
Yeah, well, I think if you look at the countries who have the most private debt, it's to GDP, the UK, Canada, Australia, a lot of it is really linked to the property market just because of how expensive most of the properties are there.
Exactly. I think it creates some issues for the central bank to give them some sympathy to some extent. So it's easy for us to say again that the central bank, so the Fed or whichever, should go and hike rates by, in this case, 75 basis points, or some people saying they should go and hike it by a full percentage point. But in reality, there's so much debt out there, both at the consumer level, but also at the corporate level, that you can't really hike rates by that much without triggering significant economic pain for a large number of people and companies. So they really have so few levers they can pull without triggering a so-called hard landing, which puts them in a slightly difficult position at the moment.
Yeah, I think we've seen China as well. While they haven't implemented that, too high interest rates, they've tried to cut back on property, debt that these companies have, and that's really impacted the markets as well. And it's 30% of their GDP, so it could slow them down.
Yeah, China's an interesting one. They seem to have a slightly different situation at the moment because they've had their rolling lockdowns, which still seem to be ongoing, right?
Yeah.
And this has really smashed their GDP, or at least GDP expectations. So the forecasts are perhaps putting that at around the 4% area, but they've been targeting 5.5%. So you think, well, if the forecasts are 4% and they're targeting 5.5%, how are they going to get there? And it seems like one of the ways they're going to get there is by relaxing some of their triple R requirements. And then you end up with more potentially risky lending to the developers and more construction, which is maybe not particularly ideal. But yeah, China's certainly trying to stimulate the economy, almost the opposite position of the US at the moment, where at least the US should be trying to take some of the stimulus out of the economy right now.
Yeah, and if you look at it, it's really many of these central banks. You look at the EU, UK, they're just in the catch-22 because of how much you can't really. Well, you probably can compare it to the 80s where Volcker, but there's just so much more debt now. So the impact that will actually have on the economy and on people is probably a lot higher than it did back then.
Yeah, 100%. But at least it means they don't have to raise the rates as much. So, for example, a 1 percentage point rise now might be equivalent to a 5 percentage point rise in the past. I think the bigger problem is that while I think the initial bedrock for the inflation, particularly in some countries, was fiscal stimulus, that was then exacerbated by supply side issues, right? And rising the rates is not really going to solve those supply side issues or take the wind out of the fiscal stimulus, but it's not going to magically create more oil. It's not going to magically create more natural gas. It won't magically solve the ammonia problem. It won't magically solve farming. So you'll end up with a situation where you have to really smash down and crunch demand for you to make any progress on inflation, which is really not a desirable position to be in, and one that certainly will raise the specter of political interference potentially. And that's something that we'll see later on in the US when we come toward midterm time, and perhaps some other countries as well.
Yeah, we've seen Fed Powell even. I think it was the interview last week or the week before. He said, "I can't really control many of the factors, but I can control the demands." And I think, as you said, that's what they're really going to try and do, try and destroy that. And it'll
Yeah.
be interesting to see, yeah, if they go 50, 75, 100 basis points, because I think that would be, yeah, as you said, it'll be unheard of for so long.
It's one of those interesting ones where I'm trying to avoid the temptation of trading in the currency market at the moment, knowing full well that if ultimately it ends up being 75 and you've predicted 50, you'll lose money and vice versa. So a risky time to be trading for sure.
Yeah, definitely. But then I think if you look at the currency markets, the countries that are really doing well are obviously the high commodity
Yeah.
currencies that are experiencing many of the inflation. So you could say the Australian dollar, Brazil real, um, Canada dollar, US, all those currencies, and the ones that aren't doing well, obviously the yen, yield control, but as well they import a lot of energy, EU, many of those countries. So I guess that's the interesting thing about the EU. And you hear about it when you research it, but we're really seeing it now just because of the impact that the energy markets are having.
Yeah, the EU is always an interesting one because the EU, by virtue of being such this big block, right, the individual countries, sorry, have basically no monetary control. So you've got Germany that seems to be kind of going along okay, the natural gas and oil thing notwithstanding. Then you've got, say, Greece and Italy that have more issues. And then how do you get one monetary policy for all of these countries? It's a persistent issue the EU's always had, and one that I think they're going to continue to face with fragmentation between the yields on German debt, for example, and that on Italian debt. And those are just going to, the spread's just going to widen, it seems.
I think they said they're going to protect but then I was listening to a podcast yesterday and they said, compared to, if something happens to the US, they actually give you data, they give you information about what they're aiming for, the targets. Whereas Europe is just, we're going to protect, we're going to protect the spread. So they're going to obviously buy Italian bonds to try and reduce the spread between Germany, but we don't know what that spread will be, how it works. I guess it seems like investors aren't too happy with what's happening, or they don't believe what's happening in EU.
Yeah, it seems like from what I could gather, the market was not satisfied with the ECB's comments about fragmentation, and were not satisfied at how vague they were about it. And the market was not particularly thrilled with how vague they were about some of their interest rate hike forecasts. So while it looked like 25 basis points is pretty much a lock for July, it still seemed a little bit nebulous. And in the ECB meeting, or at least the press meeting, Christine Lagarde was asked multiple times about fragmentation, and the general consensus seemed to be she was a little bit non-committal about how to deal with that. And non-committal answers create risk in the markets, which is obviously something that's not brilliant if you're trying to work out exactly what things should be trading for. So that was my impression of her press conference anyway.
Yeah, and if you think about it, they're talking about increasing interest rates, and they're still doing QE. They're still buying,
Exactly.
which is crazy to
Exactly.
think.
Yeah, and it's they've gotten themselves into this weird position where they've said they need to stop the asset purchases before hiking rates, but ultimately you can do both. Like, there's nothing that says you need to stop asset purchases before hiking rates. It probably is optimal, but why don't they stop QE earlier? It's kind of like the same thing the Federal Reserve had. The Federal Reserve knew that inflation was very, very high, but they kept doing QE until like early to mid or early to Q1 of 2022, which everyone knew was not a great idea. So they could easily have stopped it earlier, and the ECB seems to be making the same mistake.
It just seems like an easy thing to do. Stop that earlier, see how the market reacts, and then you can go into, increasing interest rates. But I guess maybe they were burned from 2018 and, the issues in the repo market there. So I guess that's maybe what they're concerned about.
That's true. Their last experiment with quantitative tightening didn't last very long.
Yeah.
It lasted, what, a grand total of a couple of months, I think. And then they suddenly went back to buying more bonds. So, yeah.
Yeah, so we'll see what happens. So if we look at inflation, what are the indicators that are showing us that maybe it's becoming a bit more sticky than we thought previously?
Yeah, I think the main one is probably, well, if we just look at headline CPI, right? So headline CPI had increased above, above expectations, and also B, more than it was last time. Both we're looking at this yearly, but also month on month. So month on month, it went up 1%. Yearly, it's 8.6%. And at the core level, it went up 6%. And the expectations were 5.9%. So everything's both A, above expectations, and B, in the case of headline, higher than last month as well. I think the problem that's making it much more sticky is if we look at headline, right? Headline includes food and it includes energy and the other commodities. Core doesn't include those. So it's supposed to be things that are not going to be super volatile. Now, it makes sense to have that dichotomy if you think commodities are a one-off blip. So, for example, say a mine happens to be closed and it cuts out of your lithium or iron or whatever. And that's a one-off monthly thing. It gets resolved next month and it's just volatility. Then it makes sense to look at the difference between core and headline. However, in this case, headline, so energy and food, is feeding into core. So the higher is your energy costs, the more expensive everything is going to be because transport costs go up. The cost of keeping the lights on at a medical practice goes up. The cost of everything gets more expensive. This gets passed on to consumers. So services get more expensive overall. So headline, energy and food is feeding into everything else. And that's why I think the sheer stickiness of headline for such a long period means that it keeps inflation remaining relatively high. And we're still seeing that work out, right? So if we're seeing energy go up, so fuel, I think, went up, what, 16 or so percent in the latest US reading. If we're seeing it go up that much, that will easily feed into everything else. Hence why it becomes sticky. You've also got wage growth. That was what, 5.2% or whatever, year on year. So you've still got strong wage growth, which also makes it a little bit sticky. But I think the impact of that is winding down. So in short, it's basically that the supply chain issues are still there. They're still going to feed into the cost of everything else going up. So that's why it ends up just becoming so intransigent at the moment. And there's not really any magical solution to the supply issues we're facing. So really, as long as we don't have a resolution to supply, we're going to keep getting prices at this elevated level. I think the resolution comes when you've got a base effect, i.e., everything's raised so much that, well, I'll rephrase that. When you've got inflation, you're looking at the CPI at the beginning versus the CPI right now, right? So your CPI inflation is the change therein. Now, if your base goes up, then automatically your CPI inflation goes down, right? So if your base has already risen and everything's already adjusted upwards because supply shocks have caused everything to go up, then energy magically will be at this high level. And while it might be really expensive still, the inflation isn't there. It's just the cost base has gone up. So base effects might help to take the wind out of inflation to some extent, but that isn't really solving the underlying problem. So that's why it seems to have become quite sticky at the moment, I think.
Yeah, and I guess if you look at many of the issues really in the past few months, Ukraine, Russia war, and obviously the lockdowns in China, which have really like amplified the supply chain issues. So those are the things that really the Fed or anyone else can't control at the moment.
Yeah, exactly. And I think the situation in China, so the end of lockdowns, I think for the next one or two inflation readings could easily push that a little bit higher. So we're seeing predictions that that could easily come in at 9% or so. And that's largely because the end of the lockdowns in China, and they are sort of ending, will have two primary effects for inflation. One, supply chains will get back online, so ports will properly reopen, things will start getting made again. That will be good for inflation because then there will be more things being produced, things will get transported, everything will go more back to normal. The bad thing for inflation is as lockdowns end, you'll get more demand for everything. More demand for oil, more demand for gas, and reportedly, basically no cars, for example, were sold in Shanghai during the lockdowns. So if the lockdown ends and people go back to buying these things, then that will be inflationary. Now, that initial bit, that inflation, that's going to be what you really see first before the supply chain things happen. So the supply chain thing is going to take a little while. And I think the inflation reading could edge a little bit higher as that initial stimulatory part feeds into the data. So it certainly could get a little bit worse before it starts looking better.
Yeah, I think Shanghai, are they going back into another lockdown or something like that? I'm not
Yeah, a
sure. Yeah.
partial lockdown. It's continued rolling lockdowns. From what I read, it was not the whole city, maybe about a third of the city, which still seems very, very large, almost impossible for any other country to actually manage. But yeah, it's still ongoing.
Yeah, I think if you think about it, like the whole of Shanghai has the same population of Australia, which is crazy to think. So,
Exactly.
and it,
Yeah, and Australia had its issues with lockdowns as well and trying to operationalize those.
was going to say it reminded me sort of what they try to do, but thankfully for the moment
Yeah.
that's all over. So if we look at maybe indicators to watch out for to see if this is turning around, do you think it's the main indicators you mentioned there? So wage inflation, and obviously looking at core, and just making sure, seeing if there's a change in those, or
I guess we have two things to really look out for, right? So inflation and uh, the market. So whether the market's bottomed. So in terms of inflation, I think the thing to look out for there is whether there's an actual resolution of any of the supply issues. So like I said, I think in the short term it will remain relatively high because there's probably going to be more demand pressure coming from China. And that demand pressure will hit in before the supply benefits are really felt. So inflation doesn't look like it will be turning around immediately. In terms of the impact of the Federal Reserve and the ECB and other central banks, that again is felt with a bit of a lag. So it does have an initial effect, but it does take a little while for it to feed through into the economy, particularly in the US. So if we're looking at the US mortgages are 30-year mortgages, right? So if, for example, you bought a house last year when mortgages were super low, mortgage rates were super low, you've banked that in for 30 years. That's different from other countries where, say, for example, in Australia, they're variable rates. So if the central bank hikes rates, you feel that immediately. So you'll get a very different situation. For the US, it will take some time for the impact of rising rates to feed into consumers, even if it can immediately feed into some corporations. So we're still going to have that coming with a leg. So that will not help with inflation anytime soon, really. Supply issues don't seem like they're going to get resolved other than through China at the moment. So inflation doesn't seem to be coming down very rapidly. It seems like one would expect it to attenuate by the end of the year, in part due to base effects, and in part due to some supply being resolved, but not magically fix itself. In terms of whether we expect the market to have bottomed, at the moment it doesn't really look like it. Most of the expectations are looking at it maybe continuing to go down, particularly as recession expectations are pretty high. So we're looking at potentially still quite a bearish market at the moment. Things to look out for with the market would be, well, you have technical things, which I'm not a huge fan of, but you have things that you want to look out for in terms of whether consumer sentiment starts to pick back up, because that's a leading-ish indicator. What's going on with consumer spending, and whether that's signaling that people are spending in a healthy way, as opposed to just loading up credit card debt, which seems to be what's happening. And you would also want to look at corporate investment. So are corporations going out and firing a lot of people? And we're seeing that with some corporations, and we're seeing inventory build up at other corporations. Or is the inventory kind of stable and are profits continuing to operate in a sustainable manner? So one can contrast Target and Walmart with what you'd want to look for in a healthier situation where the inventory is not stockpiling. So those are some things that I'd be looking for at a broader level, more economically speaking anyway.
Yeah, well, I think if we look at mortgages in the US, I think I saw something where they've reached 6%, which is crazy to think it's compared to where it was just a year ago. And then the consumer sentiment you mentioned there, I think the Michigan statistics, it was the lowest it's ever been in 80 years, which is
Yeah, the
mind-boggling.
Michigan consumer sentiment was a dumpster fire, like absolutely awful. That said, apparently part of that could be just the way I saw it expressed was consumer surliness, i.e., consumers were just grumpy. So it's not that they weren't happy to spend; they just felt angry, so they decided to respond negatively. And I don't know how true or not that is, but you see it in other surveys as well. So Bloomberg did, admittedly not a super scientific survey, but a survey nevertheless on YouTube. The Bloomberg channel there, they had a survey. It was like, how confident are you about the economy or something like that? And there was like, I'm very, very confident, not confident at all, or kind of like a middle of the road, don't really know answer. And like 70% of people responded not confident at all. And they got 40,000 respondents or so. So like you're seeing not brilliant sentiment, although how that manifests in what people actually do is another question.
Yeah, well, I think we did see, I think it was yesterday, the UK actually had quite a big shrinkage in the economy in the last quarter. So I think it was negative 0.3%. So I guess that could be showing that this inflationary impact is having an effect on economies, and, could have an effect also in Europe. I think Europe's, was it Germany's spending, or I can't remember what it was, but it went down 5% or something like that. So it looks like it is having an effect on some countries.
Yeah, I think in the UK, I think the Bank of England essentially warned of stagflation. So the Bank of England basically said, well, we think GDP is going to be demonstrably worse than people are saying, and we're expecting inflation to potentially be 10%, which is pretty much stagflation. GDP is either stagnant or potentially decreasing, and inflation is very high, equals basically stagflation, depending on exactly how you want to define it. And obviously, there's no set definition, but still, not great is basically what it means.
Do you think we'll see that in other countries, or is the UK maybe unique in that way?
Um, okay, so in the US, we're seeing inflation not quite at the 10%. I think in the US, it probably won't get much higher than like the 9-ish percent area, and then we'll probably start tapering back down. In terms of whether there's a recession, I mean, the predictions are it's probably like a 40-ish percent chance of a recession. So it's possible. But the issue is not so much whether there's a recession, because you can get a recession kind of technically, well, in two ways. Either the NBR declares there to be one, or you've got 2 consecutive quarters of negative GDP growth. So you've got either of those two ways of looking at a recession. So it's possible there will be a technical recession. The issue is whether it's a bad recession or a recession that lasts 2 quarters and then it's fine. Uh, in other countries, so EM countries, I think the situation could be much worse. So Turkey, for example, has inflation of 73%, which is staggering when you think about it. Like it's insane. The Turkish lira is devaluing that much. So a lot of other countries have significantly worse issues and significantly different solutions to get around those issues than you would look at in, say, the US. So if you're in Turkey, right, you might even be looking at, well, do you go out and buy a Rolex as an inflation hedge? Because at least then you know that's trading in a global market. Whereas that play probably won't work if you're in the US, because you've got very different economic dynamics. Now, the situation with Turkey is a little bit twee, but I mean, you're looking at different ways of approaching the inflation and different exposures than someone in the United States might have. So certainly, we're going to be seeing negative outcomes in other countries, I think.
Yeah, and if you think about it, like the more that the UK and the US and Australia do to actually try and protect their citizens, so subsidies, taxes, all this stuff, it's literally just going to export the prices to these other countries that maybe can't afford it. And we've seen that grain issues with obviously Russia, Ukraine. So it's just like a dichotomy of all these different factors that unfortunately could have a massive effect on many of these countries.
Yeah, you're seeing that in Australia at the moment, and I don't know whether very much news, if any, filters through into the UK or to your viewers, but the former Prime Minister Malcolm Turnbull recently called for bans on gas exports. I think it was, and you're just thinking, I'm not sure he's. I wonder whether he's just saying this to absorb some political oxygen, because obviously, if you ban gas exports, then that may solve something in the short term in Australia. It will hardly help Europe or other countries that are having issues with natural gas. So it just exports the inflation elsewhere and also creates issues domestically. Because if, for example, you're banning exports of a particular commodity, then automatically within that country, it kind of imposes a bit of a price ceiling on that commodity in the country because they have less demand. And if there's a price ceiling on a particular commodity, then automatically some production becomes uneconomic. And then automatically you get less supply, which is ironic given that supply issues are partly driving the inflation. So you've got a number of measures being proposed that aren't particularly well thought through, I think.
Yeah, and the issue is if you do it once, and these companies might be less willing to invest in
Yeah.
more production in the future. So it's just this whole. I guess it's what we've seen in oil as well over the past 5 years, which is potentially why we're here now as well.
I mean, it's the problem with the super profits tax, right?
Yeah.
It's an issue in the UK where I think when you with any commodity, there are good years and bad years. And particularly with something like oil, where the writing is on the wall, oil won't be profitable forever. Eventually, EVs will supplant anything that runs on oil-related things, for example. So oil won't be profitable forever. And oil has been incredibly volatile. It hasn't always been at these prices. During the height of the pandemic, it was much worse. So basically, your good years make up for your bad years. And it's the same with agriculture. Like anyone who's had any farming exposure or has relatives who own a farm knows that the periods where your beef sells for a ton are going to make up for the years where you've got a drought or a flood or whatever. And as soon as you start imposing super profits tax, you ignore the fact that profits are there to offset the bad years, particularly for a volatile company. It creates a complete disincentive to set up business within a particular location and or to reinvest. So it hardly solves the supply issue. And the US has its own problems with that as well.
Yeah, and they say, oh, they're marking it up. They're taking all this money off people. It's like, no, it's a market. It's literally whoever's willing to pay the most gets the asset. So I think that's a thing where I guess there's all this dogma behind it, and they're bad, we're good.
It also depends a little on the country as well and the
Yeah.
regulators. So, I mean, if you're looking at the US, you've got regulators that exist to prevent price gouging, so to speak, similarly in any other country. So, while it doesn't mean that price gouging doesn't occur, regulators exist to police that if it is actually the case. So, one can prevent price gouging without imposing a super profits tax. You don't need to do the more extreme measure to get on top of the underlying problem. And it's basically like trying to address the problem with a sledgehammer when a scalpel would have done. It's a little bit ham-fisted sometimes, some of the measures, but they do sound good in sound bites anyway.
Yeah, definitely. So I guess if
Yeah,
we go further out and we look at the past 40 years, you could say, we've seen definitely a decrease in inflation until the last few years,
yeah.
potentially because of very favorable, demographic, globalization, all these factors. So do you think that maybe with the trends reversing, we're seeing obviously demographics becoming older in many of the Western countries and China as well, and, maybe deglobalization, onshoring of many productions and, solidifying supply chains? Do you think it could almost go the opposite way, become maybe an inflationary decade, and there's not much that the Fed can really do about it?
I guess it depends on who you ask. So
Yeah.
if you listen to Kathy Wood keeps telling us that there'll be deflation, both now and structurally into the future. I don't know whether I agree with her, but in terms of whether it will be inflationary, it's really tough to know. So I think companies are doing some of what they already should have been doing. So they're making sure their supply chains aren't suffering effectively a key man risk, i.e., they're basically making sure their supply chains aren't going to be knocked out by one country going into lockdown, which is something they should have had a contingency plan for already. At least have thought through what the ramifications would be, because they should have at least thought through, well, what happens if the port in Shanghai is closed for whatever reason, be it a strike or whatever. They should have already thought through that, and resolving some of those issues they should have resolved already will be a little bit inflationary. The issue with populations is really tough to predict, right? So you've got a reduction in populations that might reduce demand. So to some extent, that could be a little bit deflationary. And potentially, if we believe people like Kathy Wood, increases in productivity might also help to be a little bit deflationary as well, if supply really starts to pick back up. So, to some extent, people like that make a valid point about improvements in productivity. I don't know that we're going to head into a large amount of deflation after 10 years. For the next 5 to 10, we could, because we will see that onshoring and moving from just in time to just in case supply chains. But we're also going to see a transition from fossil fuels through to renewables, which is going to be costly. And one can acknowledge that you need to do it while also acknowledging that it costs money. And that means that it could be inflationary. Energy prices could remain elevated for an extended period as we try to make that transition. And I think people who ignore the cost are perhaps being optimistic about how much it ultimately will cost consumers and all people who are doing it. And that will be inflationary for a little while, but ultimately will resolve itself. Because if you've got unlimited solar supply of energy, then clearly energy prices can start decreasing after you've built it. But you need to build it first.
Yeah, I think if you think of it, everyone's just going to be clamoring for the same resources, the same technology. And as you said, in the short term, it's bad, but in the long term, hopefully it resolve itself and Europe and all those other countries can get off Russian gas.
True. Well, we're seeing technology improve, right? So even with wind turbines, like a historical problem with wind turbines, they would produce energy. And there are several issues. I'm not per se an expert on wind turbines, but a problem with them, of course, is damage, right? So they either get damaged by lightning strikes or wind or random things flying into them. And that's super costly because you need to either, A, if you leave it too long, you need to replace the whole thing, and or you need to do repairs. So technology is coming online to help you detect that earlier. So various technological advancements are going to help get on top of the costs. It's just that the technology needs to get up to speed. And without that technology, for example, that's wind turbines, but we can think about other types of renewables as well. Without that really coming online, things can remain more costly than they ultimately will be. So yeah, there will be a clamoring for resources. We're already seeing that with inputs into solar, for example, and inputs into EV batteries.
Yeah, I think that's the thing. As long as there's no, because I guess the concern may be that we could get wind turbines and solar panels, but will there be, massive shortages of batteries to actually store that energy? So I guess that's the challenge
Yeah.
of, these systems are so complex, aren't they? There's so many moving parts that one thing can have a massive impact.
Yeah, and then what happens with the various mines for those various commodities as well. So I suspect there'll be a clamoring to take control of those mines wherever they ultimately happen to be for whichever product we're looking at.
Yeah,
But
definitely.
at least some countries, Australia, for example, will be able to plug its iron ore and things for the wind turbines, even if we don't have resources for solar.
Yeah, exactly. Well, yeah, I think what the new Labor government, they were sort of quite anti fossil fuels and stuff beforehand, and now they're like, no, they're okay. We need them for the short term.
Yeah, I think for I guess people who aren't familiar with what happened in the Australian election. The Australian election involved the prior party was really not fond of renewables and did rather like, or at least like the jobs created by fossil fuels, and didn't really want to enter into the discussion. The opposition party seemed to change its tune over time. So it changed its tune closer to the election to basically be vote for us. We have the same policies as the incumbents, but you happen to dislike us less. So basically, we'll
Yeah,
rip off their policies, but we won't be them, is basically what their policy platform was. And then after they've gotten elected, because they got a majority in parliament, which wasn't totally clear they'd get, they decided they could just move even further away from renewables because they don't actually need to court any of the independents or any of the other people that might otherwise have had power sharing. So at the moment, it seems like fossil fuels will continue much as they were before.
yeah. I think in
That's at least what I'm reading, how I'm reading their policies.
Yeah, I think, at the moment, just with everything that's happening, if you're an incumbent, as long, if you're up against someone who's centrist, center left, center right, you're in trouble. As long as, in
Yeah.
France, we saw that, Macron was up against someone who was far right, so that might have helped him. But I think if you're up against someone who's similar and just talking about the cost of living, you're definitely in trouble.
Yeah, I think the plus side with this last election was we almost managed to avoid that to some extent, because the incumbent party, the prime minister, uh, was not particularly well liked at a personal level. So he was personally not very popular. Regardless of what you think of his policies, he wasn't personally very popular. So the opposition party could take the small target approach of ripping off the incumbent party's policies mostly. Like they tinkered around the edges, but they're more or less the same policies. But just say, well, we're not the person you hate. We'll just be the same as them, but a little bit less annoying. Which meant that we didn't quite get the extremes this time, which was an interesting and probably welcome change. And probably one of the reasons they kind of slid into power because no one was really campaigning against them because the policies were very, very similar.
Mm.
But like in France, we had Marine Le Pen against Macron, like very interesting, to use a euphemism, right wing policies or populist policies, sorry, against Macron. So we're seeing more polarization in a lot of countries, which, if one of the polarized parties gets in, could have very negative economic consequences, I think.
Yeah, definitely. Well, I think the Liberals were the ones who lost, and if they've voted Dutton in now, so I don't think they've learned from their mistake because it's not very liked.
Yeah, that's very true. If he happens to be listening, and I'm sure he isn't, my advice to him would be to own the potato head meme. I think if people are going to call you Mr. Potato Head, you should at least own it. So
Or
I'd be
Voldemort
having
as well, I
campaign
think.
stickers with potato head on it, or just I'd be putting my branding on a potato and selling that as campaign merchandise or something. But I don't think you'll go down that route.
Yeah, probably not. But Mark, thanks so much for your time. I'm sure we could talk for hours about all this stuff. So I guess my last question, what is one message you'd like listeners to take away from our interview?
I guess the message I'd take away more broadly, and it's something that I've observed as a personal bugbear in finance and finance rhetoric, is that I think it's important to make decisions in an evidence based way, to be slightly hackneyed about that, because while it relates to what we're talking about with inflation. You need to look at, well, what is actually going on in the economy to look at whether there's going to be a recession, i.e. looking in nuance at how consumers are behaving. What's really driving their actions? If they're spending, are they spending in a way that is sustainable for them, or is it spending in a way that is unhealthy and just racking up a lot of debt? But that general principle applies more broadly to things like ESG, where it's important to look in depth at what actually drives returns and what doesn't, rather than just kind of relying on sound bites. And I think there's been a lot of noise in the finance discussion, and a lot of it hasn't been particularly helpful. And I think that's why we see a lot of the really broad swings in things like crypto, where people have kind of wanted to invest in something that looked good without necessarily having a fundamental basis for some of the decisions being made. And we see that through policymakers through to the ESG rhetoric that, for better or worse, some of it isn't very evidence based, through to some of the trading decisions we're seeing people make. So I think that would be the main takeaway I think policymakers and traders would gain, I think.
Yeah, I think that's a great insight to leave everyone with. So, Mark, thanks again. I know you have your own YouTube channel, so I'm not sure if you want to talk about that, and where else could people maybe find your work that you do?
Well, thank you for the YouTube plug. Yes, I have my own YouTube channel under my name, but also called Finance Mark, rather inventively. But yeah, if you want to find my other work, I guess you can search for my name. I have various journal articles, so they're variously available on via Google and SSRN, which is a journal article repository. And I also have a Substack, so you can check that out. I write there when I get bored, so feel free to check that one out. There might be something vaguely insightful there.
Awesome. I'll put that all in the description below. So, Mark, thanks again.
Thanks so much. It was great talking to you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.